Hi there, traders, and welcome to the live trading session. Now, I'm going to cover the topic how to interpret and trade central bank interest rate probabilities. Now, this is a really good feature that Refinitiv have come up with. It's not readily available, I don't think, on the Metastock icon at this stage, but it is something that I will be sort of including on our dashboard, some components of this, because it's very important to tracking the fundamental releases and where the central banks are. You know, for new traders to the market, this is a little bit of a game changer because it allows you to disconnect from the market and then come back, and automatically you'll know exactly where the central bank is and what the accumulative effect of the macro fundamentals has on the forward guidance from the central banks. And that is, you know, what we're talking about there is, are they going to cut rates? Are they going to raise rates? Are they going to leave rates unchanged? Okay. So, you know, what it does, it just sort of takes out a lot of the guesswork, as I said. And if you're not spending a lot of time in front of the screens, and you know yourself, over the course of a month, you do get lost in a lot of the activity of the various instruments, right? Whether it's US numbers, Canadian numbers, Aussie numbers, Euro numbers, etc. Sometimes it's very hard to keep up to speed with what is going on across the board, right? So the interest rate probabilities, now these guys, I know they've been working on this for a couple of years. It is derived from a range of basically implied market prices of interest rate derivatives, okay? Forward rates, Fed fund futures rates, and other central bank overnight index swaps. And what they've done is they've worked out a calculation that adjusts, so these probabilities adjust with various macroeconomic releases and also various news, right? And for example, like overnight, we've had the Federal Reserve Chairman, Jerome Powell, come out and start talking about, you know what, the three US inflation readings over the second quarter add somewhat to confidence that the pace of price increases is returning to the Fed's target in a sustainable fashion. Now, that alone will have an impact on the interest rate probability of the US dollar, right? And let me just give you a bit of an example here, because this is some of the tangible things that you can't see as a trader, but what we can do now with access to the interest rate probabilities, we can have a look a little bit deeper here into what the Fed are doing and when they're going to do it. That's the most important thing, right? And this goes a long way to determining the trend for the US dollar, which I believe now is down. And let me just show you why. Okay, so on the interest rate probabilities page, okay, looking at the Fed. Now, the current page I'm on, it's a bit of an overview of, you know, say the top 20 central banks. Now, we are generally interested in the uniformity of, say, the top 7. Okay, that gives us a lot more control around what's going on. Now, as I said, this page here, right, tells us the most probable action for the upcoming meeting, right? Next meeting date, right? It has the date for the Fed, no change, 91.5%. Okay, the least probable action, 0.25% cut. 8.5% probability, right? And once again, that's factoring in all the past fundamentals of the US dollar, plus any external, I wouldn't say geopolitical, but you know what? Central bank comments are factored in here. So there's no change. So you might be looking at that and thinking, well, that's great. Okay, so the US dollar is not going to do much. But if we dig a little bit deeper, devil is in the detail. Right. And this is going to, when you start putting central banks against each other, what their plans are, you can start to see a bit of shape around where the potential trend for each currency that central bank is managing. Okay. So now there's a bunch of different things on this page. Now, drilling into the Fed has the Fed FOMC rate decision. Okay. One of the key components here is looking at the current rate, right? And when they last changed that rate. Okay, so you can see exactly what's going on there. Now, the implied rates and basis points. Now, these are the expected moves, basis point moves over the coming, well, 6 months, I guess, or actually even a little bit longer, probably, what's that, 9 months. So as we go down here, the implied rate minus 2.1, by September, minus 28 basis points. It's like a quarter cut. November, right? Another quarter. And we're sort of just going up in quarterly increments, right? This is what is implied in the central bank. But if I just scroll down a bit, now there's a few funky things on this page, which to me, it's just a little bit of gloss, right? And you can sort of see exactly what's going on. Like, there is some sort of value here besides just a little bit of gloss. Like the 1 month ago, okay, if you're looking at the implied yield here, right, the red one that's what the market was expecting a month ago. With the change of, all those inflation numbers, as I've been saying, have been falling, and they're not like just gapping lower. That's why the Fed is confident that the move is sustainable, because we're not seeing like the sterling, right, where we're seeing huge 1% changes. 0.1%, 0.2%, that's really what they're looking for and what they've done. So the latest, right, implied yield is that orange line or yellow line. It shows you now how the market has adjusted according to the fundamentals and what the Fed is talking about. So this is the way it's sort of shaped up. And if I just drop down a touch, right, we get down into the nitty gritty, the probability distribution for the Fed, right, coming up over the next, well, almost a year, right, 9 months or so. So at the moment, 31st of July, right, in 2 weeks, we've got the Fed meeting, a cut, 8.5%, no change, 91.5%, right? That's as, well, it's not as close to basically saying there's no change, but it's pretty close to it, right? And with that, so the market will be taking a breather. What does that mean for us? Well, it means we do have US numbers coming up. If they're stronger, right, it's going to change. Well, it's not going to change the no change, but it may impact the future interest rate decisions here. Now, they're sort of saying, and this is what you've got to take out of, as I said, if you don't have a lot of experience on the fundamentals, this is where this data can be valuable, because you're like, okay, so they're not changing rates now, but like 100% factored in, cut in September, cut in November, December, January, March, and April, right? 100% cuts are factored into the market. Well, that's what the market's expecting, right? So that's what's coming up. All we need is the data to fit into line. And this is not only the plan for the Fed, but this is the plan that all the data is telling us, right? So when you come back and you think, right, well, that's interesting. So we're going to go through an interest rate cutting cycle, right? This is exciting because it gives the US dollar clear direction. And if I look at the charts, right, we are starting to see this form now, right? What we want to be doing is looking at what various central banks are doing and compare them to each other. This is the value of most instruments or currencies in particular is determined by the level of interest rates. Higher interest rates against another currency, you will have a currency pair that is either going up or down. Now, what we've come through, and this is a good example of dollar Swiss, we've come through a situation here where, the Swiss aren't doing much and the Fed aren't doing anything. And you get these sideways moving markets disjointed. When we get a central bank coming out and being not necessarily pushed into a corner, but the plan is sort of coming forward, the Fed are going to be cutting rates, we start to see trends form very quickly. Okay. Now, sterling and Aussie, okay, very clearly going up. Now, you can actually sort of start to piece this together fundamentally. With euro, there's an outstanding sort of geopolitical issue, right? With those French elections, which may destabilize, the political background of Europe, right? So that's a major reason why euro isn't going. But then we can have a look at the ECB cutting cycle or the interest rate plan for that. And that's where we might start to see, why isn't euro going up? It'll give you a lot of answers as to why. Now, the dollar index is starting to break down, but some of these instruments will be adjusting according to both central bank forecasts. And this is where you can really, as I said, I'll go into a bit of detail here in a second, but if we look at a central bank like the RBA, there's a good reason why the Aussie's going up, right? The economic data may not be necessarily falling into line. Some of the Aussie data not so strong, but you know what? The interest rate cycle is the US dollar is down and the RBA are on hold, right? And this is where, as I said, a little bit of detail here goes a long way. So we know exactly what the Fed are doing, right? They are projected to, if everything stays as it is and keeps projecting going, the economic numbers keep slowly deteriorating or staying where they are, this is the plan, right? So if I go into the RBA, we can actually have a look at their plan going forward and start to work out exactly what's going on with the RBA. Now, interest rate probability distribution, okay, you can start to see it here. August, okay, no change, 86%. September, no change, 83%. November, no change, 81%. December, no change, 77%, and so on, right? It's not really until April next year it becomes a line ball decision. So at the moment, the plan for Australia is to remain on hold, right? So that is important, right? Because we've got, and I've just looked at the Fed, they have got the next 8 to 9 months worth of data, which is 100% cuts. So if I was looking at a long-term trading opportunity here, I would definitely 100% be focusing on the Aussie dollar, right? And this may go towards you establishing a long-term trade here on the Aussie, right? So you interpret the data, you know what the plan is, you start to come into your longer-term charts and go, right, I know what's going on here. This gives you a huge amount of structure for a long-term trade, right? So the data here tells us that the value of the Aussie dollar will be going up in the medium to long term, right, over the next 12 months. All we've got to work out is where can we get in? Now, because what happens is, of course, various geopolitical events can happen, right, which could push the Aussie down, right? So maybe some international event and the US dollar becomes a safe haven and the US dollar rallies, right, based on a geopolitical event. And we have stop losses to protect us from that. But what we can be doing is trying to establish a trade here that gets into the trade itself, right, into this long position. Now, the market has already started to move, okay? And if I look at the this chart, I'm looking at, so where's the Aussie dollar has gone up there, 66.82, which is not, it's gone up 80 points through that level, long-term level. Now, it is a little bit overbought, no drama, right? What we have to be able to do is, right now, all things being equal, I would say the Aussie dollar is going to be up around, 74 cents over the next coming months, 2, 3, 4. By the end of the year, it could be there. And when these things shift, they shift very quickly, right? You get the move over a very quick period of time. 1 or 2 months should be enough to get it up towards 70. And then once it gets going, it really takes off. Now, those interest rate positions, let me just come back and I'll explain a little bit more, because you've got to, so the plan is, right, with a long-term trade, okay, you're looking to get in at a decent level and have a good sized stop loss below support, right? So I'm saying this level here was at 66.82. What I would be looking at is the trend line where it is now. Well, actually, it's pretty much at the same level. So you want to have a stop loss below this support trend line. Okay. Now, to make things easier, let me just change it to orange so we know we're not sort of over focusing on it. So this new trend line here, the red one, is what we want to be below. Now, you can try and stagger in an order here to get long. You could either buy some sort of at current market levels, some a little bit lower, okay, and your stop loss, okay, if I just change that to red, okay, maybe below those levels there. And so what you have is you have a smaller position than than your sort of normal day-to-day. It's not a maximum risk trade. What it is it's a smart long-term trade. So your stop loss, accumulative, right, may be 100 points from here to here, right? Then that gives you good breathing room. You know, if everything stays the same, this will just go, the price of this will go up, right? The value of the Aussie against the US. And that's where you can sort of piece it together. What you have to do individually, depending on your risk appetite, is you have to work out here. So if I get long here, right, work out how much you're going to risk on the trade to the stop loss down here. Say you're risking, say $5,000. Well, in that regard, you can work out your position size here, work out your plan. And so maybe you get into another trade 40 points lower, and then another one, okay, below that. So you've got 3 different entry levels. You get into the trade, 40 points lower, another 40 points lower, and your stop loss is down here. And you work out the size of the positions. So if all 3 positions hit that stop loss, it adds up to the risk you've got on the trade. And say it's $5,000. Well, then you can quickly work out, add the 3 positions up with the stop loss, and you can work out the position size for each one. Now, and then with that, right, you want to have a structure. You know there's going to be a little bit of traffic up here when it gets to that resistance trend line. But it doesn't mean it's going to stop, but it just may mean you may start to have a look there at 69.5. Okay, do we start to think about maybe cashing in a part of the position? I would generally encourage you on a long-term trade, right? If you're getting in here, you've got a stop loss below the support level. I would be sort of saying you're looking up towards, say, 72 or above, and using a trailing stop to manage the position and trailing it by at least 100 points, right? Don't worry about, like with these long-term trades, and when you are assessing these on interest rate probabilities, right, you're not so worried about the short-dated price action, right? We're not really looking at the hourly charts, because if you're looking at the hourly charts right now, you might be thinking, oh, well, Aussie's broken down here, I'll hold off, right? But looking at your hourly charts, you might go, wow, this is interesting. I've got a slightly lower Aussie here. If I could get in down around 67.10, right, or thereabouts, then you can have either a smaller stop loss or give yourself a large amount of protection and have your stop loss still at 100 points, but in a much safer position, right? What we're trying to avoid on the longer term trades is the short term discombobulation in the markets. And this is the key to it, right? So if you are managing a trade here, a long-term trade, you don't turn a blind eye to, say, the fundamentals, although they could be important to, what's going on. Of course, if the Aussie data started to turn extremely weak, well, then we would expect the probability distribution to change, right? And this is what you could be looking at more so, interest rate probability distribution on a daily basis or weekly basis. And if you start to see a bit of a shift here in, say, the September or November interest rate predictions, well, then that's when you can start managing that long-term position. Okay. Now, it's usually like 6 months. Most of the currencies are 6 months behind the US. So, which is actually what this was actually a little bit longer for the Aussie, because they are expecting rates not to change until, the end of the first quarter in 2025, right? I actually can see them doing something earlier than that. But right now, all things being equal, this is the best part about this interest rate probability chart, is this takes out any subjectivity as far as being a human goes. And we see the numbers. You see one bad number and you're like, yeah, that's okay, I've got to get short Aussie. But you know what? This distribution, interest rate distribution, is factored off the objective numbers, forward rates, interest rate derivatives, central bank overnight swaps. This is actually what the data is telling us. So you don't have to think, right, what am I thinking here? I've seen the news, and the news can be the worst thing, right? Because you see a couple of bad articles and you start changing your position according to what you've read. They could be opinion pieces where this is natural data and you can't, it tells the story below the surface, right? The surface of the fundamentals and really any sort of news or geopolitical action. So that's one thing you can look at when you are sort of looking at opportunities here. Start to form an idea of where the longer term trades may be. And it doesn't necessarily mean you get in at this level here, right? But what it may well do. But what you want to be focusing on is some of the key data that the central banks refer to, right? When it does come up to the inflation numbers, instead of trading them on a short-term basis where liquidity can be an issue and we see prices jump around all over the place, if you've got a long-term position, you can avoid that, right? You get into the trade, and if you do see an adjustment in, say, the inflation goes from being strong to really weak very quickly, well, then you can easily manage your position going forward. And just keeping an eye on the interest rate probabilities allows you to see how the rest of the data is being factored in. So, for instance, if we started to see a major shift here in the Aussie and, say that by November, it's going to an 83% cut right here, well, you know what to do with that long-term position. You need to start cutting it. Now, even if the Aussie goes to that cutting phase, it may be a situation where the Aussie trades sideways because the Fed is already 100% cutting over the next 6 or 9 months, right? So now you can lose yourself in the data here, right? And what you want to do is just have a very good idea. As I said, I'm going to put this on the dashboard, right? Some sort of version of this where you can actually see very clearly what is going on across the major, say the 7 major central banks, right? So even if you're looking at the ECB, right? Looking at the probability distribution here, and you've got, like, this gives you a good idea as well, just how it's laid out, like 2% up to 3.75, the whole rate distribution. But you know what? In July, and this is what I was referring to yesterday, in the week ahead sort of video, like no change, 96.1%. Now, these numbers are generated, as I said, from the data. So you might be thinking, well, what about this thing in Europe? This is going on, that's going on. Don't worry about your opinion. Look at the data and trade it, right? Now, what are we expecting from the ECB? Well, they're cutting in September, expected to cut in October. Like, check this out. Over the next year, these guys are cutting the crap out of rates there, right? Once again, what does this tell me? Well, I'm looking at, if I looked at all the central banks, I'm like, well, that's interesting. They're going to be cutting. So what's the euro going to do against the dollar? Probably not much. And that's why it's not going up at the moment, because the cutting cycle here, right, is very similar to the US. So there's a good reason why the euro is not going up against the dollar, right? So if you're looking saying, oh, well, sterling's gone, Aussie's gone, I better get long euro. No, right? This is where this data is important. You don't want to get long euro because it's not really going up. Okay, that's the key to this. So, and then you come back and you just have a flick through the major central banks. So Bank of England, I won't worry about Japan because they're not doing anything. Okay, so we look at the interest rate probabilities here for the Bank of England. Okay, now this next meeting, it's a line ball decision, right? So that makes the upcoming data, any upcoming data for sterling, extremely important because it could lead to either the probability of a cut higher or no change higher, right? But either way, right now, you're looking at a 70% chance in September, 87% in November, almost 95% in December. So the Bank of England are going to be going, but they're not going for maybe a month or two. Or actually, what is it now? July, like next quarter. So they might be cutting next quarter. And then you can start to factor in, what does that do for euro sterling? What does it do for sterling against the dollar? Well, it means sterling's going to go up, but it's probably going to stall at some stage. So once again, if you're looking at the longer term picture, where can I get into sterling? Well, you might revise your projections and say, well, it's probably got another 100, maybe 200 points in it, whereas the Aussie against the dollar may have another 300-400 in it, right? So but once again, you look at the interest rate probabilities of sterling. So this is why I was talking about the Aussie, because it makes the crosses very active. You can actually start to trade crosses long term with this perspective in mind. So if I was looking at sterling Aussie, right, I'm like, well, they're not doing anything just yet. So I would expect sterling to go with the Aussie for the moment against the dollar. But by September, right, it's going to be going the opposite way to the Aussie rates, right? So that's where we could potentially be looking to get into the trade upcoming down the track. And then, as I said, you just have a view or an opinion here with what's going on with the various central banks. And this makes it a little bit easier, as I said, to digest the impact of the accumulative impact of the economic data. And you can sort of work out where the best potential trading opportunities are, right? So Bank of Canada, okay, 24th of July in 8 days, 80% chance of a cut. Well, what have we got out this week? Well, we've got Canadian inflation numbers. Very important to determining this probability here. If we get weak inflation numbers out of Canada, that will go up to like 95%, right? And that will be the driving force behind a weaker Canadian dollar. Okay, so, and then you're looking at the rates, they're cutting rates over the remainder of the year. Okay, I'm looking at that, I'm going, well, Aussie CAD, right? So this is where, once again, you start to come in and you can get a very clear picture of what is going on. So if I was to have a look here now, because I'm talking about the Aussie, the RBA is a standout. Okay, let me just go to the Aussie crosses daily. And then we can start to piece together the what's going on here. And you'll notice, like, the market's not stupid, right? Like a lot of these, like the fund managers, etc., are looking for these bigger, longer term moves. So when we are looking at, say, Aussie yen, I mean, all these things, right? Aussie's going up against pretty much most things. And it's for a good reason. It's about the interest rates. Okay, Aussie CAD higher, Aussie Kiwi higher, Aussie yen higher, Euro, Aussie down. Actually, sterling Aussie, this is not a bad one, right? Because we know sterling is going up at the moment, but in coming up down the track, sterling will be, the interest rates will be coming off against the Aussie in particular. We can have a look at Aussie, dollar Swiss as well. This makes you have a think, because I'll be like, well, okay, this isn't going to last, because the Bank of England are going to be cutting rates. So I would start to focus in on instruments where I could potentially get into trades here, longer term trades based off the interest rate probabilities of the central banks. I'll be looking at this trend line here going, well, this is going to be a good level to be getting in. Now, it's 125 points above the market. That's nothing in the big scheme of things. All it takes is one event, right? And we do have UK inflation numbers today. We get stronger UK inflation, just means they're on hold, but they're still cutting the next time round. So potentially a short sterling Aussie trade would be a good trade here. Or if it was still shooting up with momentum, at some stage it's going to come back down. A false break trade here on sterling Aussie would be even a safer bet, right? So this is some of the things that you can do with what's going on. Look at longer term trading opportunities. And when it comes to the interest rate distributions, right, really looking short term around where you might see clear direction pop up. And what I'm talking about is, if you look at have a look at the data here, right? So we've got key data coming out, inflation numbers out of Canada, and then inflation numbers coming out of the UK over the next, as I said, the next day or two. We've actually got some CPI numbers coming out of New Zealand as well. That's sort of flown under the radar. I should have looked at that. So UK, New Zealand, and Canada, UK, and New Zealand, right? So if I come back to my various bits and pieces here, I can start to have a look around and see what's the raw side of the market, right? When I'm talking about the raw side of the market, it's the side of the market that will impact most punters. Now, 14th of August, right? Kiwi, it's a line ball decision. That makes any data released now and like these inflation numbers extremely important because it's going to move the currency either up or down because the interest rate probability will shift on that. That's why Kiwi will move, either Kiwi against the crosses or Kiwi against the dollar will move according to that. So then you're like, wow, that Kiwi data is really going to come into play. And then from here, you're looking at cuts, okay, get through the roof, right? We want to sort of get into these trades before everyone's cutting. But you can see the plan here for New Zealand is very similar to the ECB, very similar to the Bank of England, okay, and the Bank of Canada. So if you look through all of these, now the Swiss don't have a lot of room here to wiggle, right? But what they are expected to do is to cut rates, well, 64%, then 80, 86, 89. Like they're line ball decisions here with cutting rates, right? For the Swiss National Bank, that'll keep the Swiss depressed. Now, why is dollar Swiss not going anywhere? Because the Fed are due to cut rates and so are the Swiss, right? So once again, you can avoid trouble here and avoid getting into trades that aren't moving. And then you look at dollar Swiss now and you go, right, I know what's going on here. They're not doing much. I know what the ECB are doing. They're not doing much. Bank of England, well, they're not going to do anything for the next sort of month or two, a couple of months. Aussie, not doing anything for a year. Now you can start piecing together where the big moves are potentially going to come from. And that's a secondary trade that you can have on besides trading the shorter term stuff as well. Obviously, trading numbers that go with the trend is more favorable, okay? And you can see here Kiwi. Why isn't the Kiwi moving? Well, RBNZ are due to cut rates, so are the Fed. So it doesn't go anywhere. And this is where the loonie comes into play, right? And why, you know, as I always sort of say, we always thought it was the lunatic. And I know the loonie is the dollar coin for Canada, but you got oil, such a major influence that it often messes up the natural flow, or it's a major part of the natural flow of the Canadian dollar, right? Which can mess things up. Because if we see a massive move around in oil, it can move the Canadian dollar very aggressively, even against trends. So that's what we're looking at, right? And so it's very important that you know how to trade, how to interpret the interest rate probabilities, because then you know exactly, you know, the upcoming data. You can actually now, when you look at various data releases, you can say, okay, let me have a look at this CPI number out in New Zealand. Well, you can check out what Kiwi rates are doing compared to the other central banks, or the likely probability of what they're going to do, and what impact that may have on the short-term level of, say, Kiwi against the dollar or Kiwi against the crosses, and really isolating the pairs that that obviously are on hold, like the RBA, right? One standout amongst the other central banks. And you know what? You want to take this a step further. You can start to investigate what's going on in some of these sort of secondary currencies. Okay, you might find a diamond in the rough there that, you know what, someone's on hold, whether it's the Riksbank. I mean, you don't want to go looking for trouble like the Bank of Turkey and some of these other countries, but there is opportunities here to dig a little bit deeper across the board, right? If I go to the overview, it's got a bit of a coverage here of what to expect, right? But the devil is in the detail. This page here, the overview, tells you what's the most probable action coming up, right? So yeah, that's important. But what's, you know, from looking at this, you'd think, oh, well, the Fed aren't doing anything. If you didn't look any deeper, you wouldn't know that they are expected to cut aggressively for the next year after this meeting, right? Which is what you need to know, right? So there's a little bit of detail here that you could use. Short term, this is the page to go to. Swiss National Bank cut, okay, 64%, right? That's not by no means a given. So you'll be watching the data there very closely. Bank of Canada cut 80%. Okay, the data may not be as important. RBNZ, 0.25% cut. 50, it's just like a line ball. When it's like a 50-50, 60-40, the data is hugely important because it can really decide one way or the other whether they're changing or not. And that'll lead to the value of that instrument going up or down. So that's what you can do with the detail here. Now, I know a lot of you guys haven't got access to this. As I said, I'm going to be referring to it quite a lot more as we go forward and giving you some suggestions around where the longer term trading opportunities may be based off this data. Okay. And as I said, the good thing is it factors in central bank comments, which it should, right? If the central bank governor or chairman or whoever it may be at the top is making specific comments with regards to inflation, and that will move that in their forward guidance. This is what they do, right? So at the central bank meeting, they will say, this is the plan. Now, if the market starts to shift in between the meetings, they will come out and have a speech and tell you, right? So this is a mid-meeting alteration of their forward guidance. So they have gone from, yeah, maybe to like, this adds somewhat confidence. So that shifts that forward guidance from the Fed. And if you had been looking at this over the course of, actually, if you look at yesterday's video, right, and if I come back into the interest rate components of the Fed again, this was, if I looked at this yesterday down here, okay, these numbers here were in the 90s. I think maybe 91%, around there. They've all gone to 100% with his speech, right? So that's the plan, right? Follow the data. Now, if we see like some major crazy changes in CPI or employment, it will be reflected in the data here. And the forward guidance comes from this, right? You can start to see the yield curve or the implied yield curve, all these other components. I mean, there's a little bit of fluff in here, to be honest. Implied versus actual, blah, blah, blah. I mean, this is great. The numbers here are the key to it, right? These numbers here, you can throw a bit of color in there with a few charts, but you don't really need to. And that's a very important component to trading the markets effectively, right? And just more accurately with the longer term trades. Like a lot of people ask me all the time, like, Brad, what about these longer term trades? How do we know if the dollar's going down or euro's going up? And you're like, well, if you didn't have this data and the accumulative impact of the fundamentals, right? We're looking at euro. It's the impact of the fundamentals from the US dollar and the euro. You put those together, and that's the value of euro against the dollar, right? So if we know what's going on with the interest rates, which is the overriding factor where the value of these two currencies against each other comes from, we know that they're both cutting. Well, you know what? It's not going anywhere. You might see a little bit of move here and there, but this is going to stay within a range. Whereas sterling, it's got a few months before they go, and Aussie, I still think, is the standout, right? I think that's where the cash will be, and it just comes from being able to get hold of this data and then also at the same time being able to interpret it and trade it, right? As I said, it doesn't mean you watch this video and you go, okay, that's it. Thanks, Brad. I've got this. I'm going long Aussie right now. Well, in actual fact, you can, but try and be methodical with it, right? Have a look. Is there any Aussie data coming up that might come in a little bit weaker? Because then I could get in at a better level than where it currently is, right? But the trends usually evolve around this data. So you start to look at the Aussie on a longer term basis and see if there's some instruments here that you could potentially get into. Okay, so we know the Swiss are cutting, so Aussie Swiss is going to be going up. We know the CAD are going to be cutting, Aussie CAD's going to go up. We know the Kiwi is going to be cutting, Aussie Kiwi is going to go up. Dollar yen has been a negative 0.1 for 30 years. It's not going anywhere. So this may just be caught up in well, I wouldn't say it's a geopolitical event, the whole intervention fears, etc. With regards the yen, that could be a bit of a nuisance. So you might question that. Euro Aussie, well, I've got to say that looks like it's going down. But once again, are we looking to get short that pair? I may not like where it is right now. Sterling Aussie, you know what? These are pretty close. I might wait for a false break trade to get in there. Okay, so as I'm showing you this, this is where the strategy to get in, you can be, with your knowledge and experience, can start to mold together plans here to get into some of these instruments if we do see some strange levels. Like Euro Aussie makes sense to be getting in, averaging in, with a stop loss above that trend line. Okay, that looks good to me. As I said, Sterling Aussie looks very good. Aussie Kiwi, I've never really liked it. We call it the Widowmaker because it does weird things, but that looks like it's heading back to 120 where it usually is. And Aussie Swiss, well, it's just a matter of drawing the trend lines, right? If you draw the trend lines, you'll find out where to get in, where these pressure points are. And that's what we're looking for. All we're looking for is an easy entry. If we know direction, then it takes a little bit of pressure off the entry level. And once again, above 60, like we see some negative weak inflation numbers or stronger Aussie numbers, Aussie Swiss, we've got a great level to get in here. All right, so that's the understanding this data. Okay, how to interpret and trade central bank interest rate probabilities, right? This isn't the holy grail, right? But it's closer to it, right? And as I said, this interest rate probability detail, they've been working on this for a number of years. It's good to see they've finally sort of launched it, and it does give us very clear detail. As I said, you don't need to have your head in the market so much now, because you can actually see what's going on and what the cumulative effect is. So if you find yourself getting hacked up on, say, the economic data releases, right? Maybe take a bit of pressure off yourself. Let's look for longer term trades to get into those if they are available, and then we can work it out. Now, just on that, right, we've got a situation right at the moment where, okay, the RBA have sort of on a no change cycle. They're not hiking, but they're no changing. Out of all the central banks, this is an opportunity because the rest of them are looking to cut as we go along. What you want to be looking at is the ones that aren't cutting yet. When are they going to go? It'll come around the inflation numbers. That's when that projections may change more than it's, say, if it's just a manufacturing number, right? Employment, inflation, they're the two numbers to watch to see for changes of this, of changes in the interest rate probability. Now, if we didn't have the Aussie on hold, you're really going to do a lot of homework, right? Because you're looking at the timing of when these changes may take place, and you could be managing your longer term positions around the central bank meetings or the release of the inflation data. And those central bank meetings in the past, that's all we've had to go on. The central banks weigh up all the fundamentals. Now we've got some data here which actually gives us insight into what they're going to be discussing and what they're looking at. This is what they look at. This is the data they look at. Okay, so this is, I think this is going to be a really good feature for everyone going forward. As I said, I'm going to do my best to keep you up to speed with this, and we'll produce some detail here to get you in the groove. All right, and that's, if you've got any questions around that, I'd be more than happy to field those questions either in the Discord or wherever, not really by email, actually just do it in the Discord. All right, guys, that's where we are. Thank you very much.